The ability to pay is the driving force behind you being able to purchase your first property. So, in the last lesson, we learned how to mathematically figure out how much home you can afford based on your income. Now you will learn what that number means, PITI. For some of you, this may be your first lesson, so allow me to introduce myself. My name is Ethan. I am the managing member of Comfortably Living, a limited liability corporation. What we do is offer economic development consulting for young adults, primarily the millennial generation. You can follow us on Facebook to stay up to date on workshops that we offer, webinars for personal development services, our small business plan writing and grant writing services, as well as home buyers workshops that are held both in person and online. And of course, my favorite part, the trends and the real estate investment community that we offer our investors. So for now, let's take a look at PITI. If you're buying a house that has a market value or sales price of $165,000, and it also has the same tax assessed value of $165,000, and you buy this house using an FHA loan. The FHA, Federal Housing Administration, requires you to put down at least 3.5%, or in this case, $5,775. So when you subtract that amount from the sales price of your home, you would end up borrowing roughly $159,000 to purchase your first home. If the bank is offering you a 3.5% fixed rate mortgage amortized over 30 years, your principal and interest payment each month on that loan would be $715. But now, in order for us to get a more complete idea of what your monthly mortgage payment would be, we have to add your taxes and we have to add insurances into that payment. So let's go ahead and do that, starting with the taxes. In the region of Texas where I live, the tax rate is 2.4%. So we multiply the tax value of your home by 2.4%. And then you divide that number by 12, which again is the number of months in a year. And this will become your monthly tax liability. Now, since you're using an FHA loan, you'll be required to purchase mortgage insurance. And this is so if something happens to you, your mortgage loan will still be paid. You'll also need to purchase standard hazard insurance in case of a fire or a natural disaster. For your mortgage insurance payment, let's multiply your loan amount times 0.0055. And again, divide that number by 12 to get your monthly mortgage insurance premium. As a money saving tip, whenever you go out to get your standard hazard insurance, or also known as just basic homeowners insurance, you may want to bundle that with your existing car insurance to save money. So in this example, let's use $70 as your monthly hazard insurance premium and $73 for your monthly mortgage insurance premium, as well as the $330 that is your monthly tax liability. By adding each of these numbers to the existing principal and interest amount, we see that your monthly PITI mortgage note would be $1,188. Now, another money saving tip may be to consider a 20-year term rather than the traditional 30-year terms. This would allow you to build equity in your home faster. Also, in the next video, I will teach you how to buy points on your interest rate at closing. Just another way to save money and build equity faster in your property. But in this video, we learn what is in a monthly PITI mortgage payment and how to calculate each element. I encourage you to keep learning because knowledge breeds confidence and confidence wins deals. What can we build together?